Short selling and buying put options are two popular strategies for profiting from a decline in stock prices. While both methods aim to generate profits when the price of a stock goes down, they have key differences in mechanics, risk, and potential rewards. Understanding these differences is crucial for investors and traders who want to hedge their portfolios or speculate on declining markets. What is short selling? Short selling, or shorting, is a trading strategy where an investor borrows shares of a stock from a broker, sells them at the current market price, and then buys them back later at a lower price to return to the broker. The goal is to profit from the stock's decline by selling high and buying low. How short selling works. Borrow shares from a broker. Sell the borrowed shares at the current market price. Wait for the stock price to drop. Buy back the shares at the lower price. Return the shares to the broker and keep the difference as profit. Buying a put option is a less risky way to profit from a stock's decline. A put option is a financial contract that gives the buyer the right, but not the obligation, to sell a stock at a specified price, strike price, before a certain date, expiration date. If the stock price drops, the value of the put option increases, allowing the trader to sell the stock at a higher price than the market price. How buying puts works. Purchase a put option with a set strike price and expiration date. If the stock price drops, the put option increases in value. The trader can either sell the option for a profit or exercise the option to sell the stock at the higher strike price. Key differences between short selling and buying puts. 1. Risk exposure. Short selling, unlimited risk, as stock prices can rise indefinitely. Buying puts, limited risk, as the most a trader can lose is the premium paid for the option. 2. Profit potential. Short selling, profit depends on how much the stock price falls. More significant declines lead to higher profits. Buying puts, profit is based on the difference between the stock price and the strike price, but it is limited by the expiration date. 3. Cost of trade. Short selling requires a margin account, borrowing shares, and paying interest or fees to the broker. Buying puts requires only the premium payment with no need for borrowing shares. Which strategy is better? The choice between short selling and buying puts depends on an investor's risk tolerance, experience level, and market outlook. Choose short selling if you have experience managing margin accounts and understand the risks. You are confident in a long-term decline of a stock. You are willing to accept higher risk and potential margin calls. Choose buying puts if you want to limit risk and avoid margin requirements. You prefer a simpler way to bet against a stock's price. You expect a short-term decline in the stock. Many investors prefer buying puts because of the limited risk, while short selling is often used by advanced traders and hedge funds with risk management strategies. Short selling and buying put options are both effective ways to profit from declining stock prices, but they come with distinct differences in risk and mechanics. Short selling offers unlimited risk and no expiration date, while buying puts has limited risk and a fixed expiration date.